Hello everyone, David Wilson here from Everett Matson and Furby. Now I'm here to talk to you today about how to value a fish and chip shop. Now, if you own a fish and chip shop and you're looking to potentially exit, or you're potentially thinking of acquiring a fish and chip shop and you want a steer on, what valuation multiple has been used, or get a steer on, what is the split between property and the business. This video is definitely for you. So let's kick this thing off, and what I've done for you is I've been and found a set of profit and loss accounts from a fish and chip shop that we'll talk through. So EM&F, Everett Matson and Furby, has been going for the past 56 years, and we've sold more fish and chip shops than you've probably had fish and chips. So if you've got any questions around the sale of a fish and chip shop, please just drop me a message and I'll certainly do my very best to help you. Now, what we should do first of all then is let's switch the screen over and take a look at this profit and loss statement. Right, so the first thing I want to just talk to you about is when we look at any business, there are three major elements that build up part of the valuation, and it's called the build-up approach because the very first part of it is to look at what is the trading business doing, what profit or loss does this business make, and what impact does that have on the value of the business. So that's the first section, and the second section is if there is any freehold property, any freehold commercial property that is used in the day-to-day running of the business. And the third element is any accommodation. Now, a lot of fish and chip shops have accommodation maybe above or attached to it, whether it's either on a freehold, you own the freehold of the property, or you're leasing it off somebody else. So there are considerations to put into place to build up this valuation. Okay. Now, so this profit and loss is an example one that I've pulled out from the archives. When working on your valuation, fundamentally what we're trying to do is we're trying to work out what the adjusted net profit is. So what we need to get back is, how much realistically does this business put in your pocket every year? Okay. Now, you should always use the most up-to-date accounts. So here I've got 2017 accounts. That isn't late enough. I've just pulled a random one out of the file just to give you an example. In fact, this business that I'm talking to you about is closed, so it's it's long gone. It's been sold and so forth. So first things first, as we can see on here, the sales. So let me talk a little bit about the construction of a profit and loss account. A lot of business owners, believe it or not, just they might have a vague understanding of how they work, but just a real brief run through just to really crystallize how a profit and loss works does the world of good. So as you can see, so we've got sales just down here, so that is sales without any VAT. So if you're VAT registered, which with sales of this much you will be, this does not include VAT. VAT on management accounts like this or end of year accounts will always show without any VAT. So sales of 183,000. Cost of sales, that's the cost it costs to deliver your product. So that's what it costs to buy in the raw materials, that the fish, the chips, the fat, the paper, etc., to give you a gross profit of 118,000. So this 118,000 hasn't factored in any of the fixed costs. Fixed costs happen regardless of whether or not you take any money this month or not, or year. So the gross profit is dependent on sales, but the fixed costs, which are listed down here, are going to happen nonetheless. Okay. So employee costs, we've got £37,000 worth of employee costs. We've got some costs for premises in there. So this straight away, alarm bells start making me think this is a leasehold business. So we've got some money in there for repairs, general administrative expenses, motor legal expenses, some interest on there, some finance charges, and some depreciation. All in all, the top half is the income, and it leads down to the gross profit, and then you've got the total expenses down here. And to end up with the net profit, which is down here, we take the gross profit of 118,000 and we take off the £86,000 down here, leaving us with a net profit of £31,305. Now, just touching on that, what I'm going to do is I've taken all these figures and I've put them into a spreadsheet. And this is our valuation spreadsheet that we use with every single business. Now, the first thing to note on here, I am merely looking at, in fact, that's just wrong, it's 2017. I'm merely looking at this year, the 2017's accounts. What we really need to do, if I had 3 years worth of accounts for this fictitious business, we would have the last 3 years in here, the last 3 years worth of gross profit. If there's any additional income, let's say you rent out a flat, that would go in there. And we'd want to sort of build up a picture of what the gross profit looks like over the last 3 years. I know in recent years, fish and chip shops, the cost of fish has started to soar, so that's definitely affected the gross profit. But a 65%, probably a little bit on the low side for a fish and chip shop, but it's still within relative parameters. Okay, so this, based off the accounts, this is the income, giving us a gross profit down here and the gross profit margin, so we can see 64%. Down here, just a little bit below, we can see a list of all the expenses. So you can see we've got wages, telephone, and what I've done is I've gone through and I've filled all these out based on what's in your profit and loss account. Now, if we flick between the two, not that one, no, that one there. Yeah, if we flip between the two, these figures on a separate page, we go into a lot more detail. It's just another page of the accounts, and I've pulled out all those figures and put them in here. Now, as you can see, hire purchase on equipment, we've got £1,800 in there for the hire purchase. Now, because this fish and chip shop is it's owned by a person, that the business is owned by a person, it's not a limited company. When they sell that business to another person, it will be called an asset sale. And when you have an asset sale, any finance remains with the individual, not with the business. So this hire purchase of equipment will be settled upon exit by the exiting party. Okay, so realistically, for a new owner, they won't have that expense. That will come straight off. Okay, so we add that back. Going further down here, we've got some legal and professional. We've got £900 of legal and professional there. Now, for a fish and chip shop, realistically, they don't have much legal and professional work. Now, having spoke with the owners on this one, the £900 was a one-off. It was a legal bill that came up, and it was completely one-off. It isn't necessary in the operations of the business, so we can quite comfortably add that back. So that goes over into this column. So all add backs are going in over here. The actual figures are here. So let's just put one off. This will be settled on exit. A little bit further down, bank interest on loans. Just the same as what I said with the hire purchase. The bank interest will be paid off when you sell the business, so therefore that can come straight back. And depreciation. Depreciation is an accounting term. What they do is when you buy something, let's say you buy a new range or a new big piece of equipment, rather than having the tax benefit of that all in that 1 year, the accountant will write that down over a number of years. So in year, let's say you buy a new range, it costs you £10,000. They might write that off by £3,000 per year until it's all paid off. Now, you've paid cash for this in year one, but you're getting the taxable benefit for it over the next subsequent years. So even though that is showing as an expense, it's not a cash expense. It's not an expense that actually affects the cash that goes into your pocket. So that again can be added back on to the profit and loss. So this figure here, 86,801, is the same as the figure that we had on the other set of accounts. Let's go a little bit lower down here. So we can see if we look, net profit from accounts is 31,000. So as we can see, look, we had 31,305 over here. It's the same over here. Now, the things that we've added back in this column, we total them up and they total £3,700. Yeah. Now, there may be, if we sat down with looking at your business, there may be other things that we could take back out of there. For instance, you've got £1,000 on telephones there. It could actually be that the telephone, it's a personal mobile phone. 95% of the time you're using it for personal calls. Only 5% of the time you perhaps might make a call to a supplier, etc. And you're putting that expense through the business. Now, that is not a business expense. The 5% is, that's definitely a business expense, but the 95% definitely isn't. So you would be able to factor that back out. Again, wages. This business pays out £37,000 worth of wages. Now, those wages are actually being paid. I think there's a couple of part-time stuff in there. The majority of those wages are being paid to the business owners. If it's being paid to the business owner, we need to add it back. So let's go in and add back 25,000 as an example. Okay, paid to business owners. So as we can see here, now our personal and exceptional totals are 28,000. The net profit from the accounts is 31,000. That totals £60,000. So realistically, if someone was to come in and buy this business, they would come in and they would earn £60,000 from the operations, keeping the business exactly the same, not changing anything, just running it exactly the same as you've run it. They would earn £60,000 a year. Now, when we sell a fish and chip shop, or any business in fact, there is always a multiple, and the multiple dictates the value of the business. Now, at the moment, at the time of recording this, the start of January, well, it's actually February 2020, the valuation multiples for a fish and chip shop in the UK are around about 2 times adjusted net profits. Now, notice I say adjusted net profits. These are the net profits that we've adjusted back to include any wages that go out to the owner. If this was a slightly larger business, it was larger in terms of turnover, and it was maybe management led, you would leave costs in for the owners of the business, but you would use a higher multiple. Most fish and chip shops, you'd be selling this, marketing it to somebody whom is going to run the business day to day. So we'll stick really simply, and we'll add back any wages that are needed, that are traditionally paid to the owners, because they are realistically going to be paid to the people who are going to be buying your business. So down here we've got 3 multiple variations. So 2 is a 2 times, so £60,000 worth of adjusted net profit on a 2 times multiple gives us 120,000. Now, EM&F have been selling fish and chip shops for the past 56 years. We know exactly what the multiples are at any given time, and they do fluctuate. They really do. If you want to sell your fish and chip shop fast, let's say there's a reason behind you need to get out quickly, we'd probably tend to look to lowering the multiple to the 1.75, 1 3/4. However, if you're in not such of a rush and you're just waiting for that perfect buyer to come along, then you can potentially look to advertise your business at a premium, and I'd probably go in at the 2.25 mark, giving you an uplift in the valuation. Now, this business, as I said before, is a leasehold business, so there is no freehold value attached to either the business or the accommodation. If, however, you own the freehold of the business, so you own the freehold property, you own the fish and chip shop itself, the premises, you would need to go out, get an independent valuer to come out and value the commercial property. EM&F do that. We're more than happy to come out to you. If you're anywhere in the UK, we cover the whole of the UK and Wales. So give us a shout. We can always come out and see you to do this and go through our valuation in much more detail with you. So we would use comparables to get a valuation of the business premises. And lastly, as I mentioned before, accommodation. If there's any accommodation with the business, that would be added on, that would be separate to the transaction, and we would value it separately and add that into the mix. So fundamentally, if we're using a standard multiplier of, we were saying here that we've got 120,000 for the value of just the business. Now that is that for the benefit of the lease, the fixtures, the fittings, and the goodwill, all wrapped up together. Now, if it's a business that has a lot of stock or a reasonable amount of stock, we always add the stock on afterwards. So it's always that price plus stock at valuation. Okay, and stock at valuation, all it simply means is when you sell your business, the date of completion, you get an independent stock taker to come in. They look through all of the stock that you have at cost price, and they come up and they say, this is the value of your stock. And the purchaser would have to pay for the value of the stock in addition to what they're paying for the business. So if there was a freehold premises in there, we could put the comparable in here and accommodation as well. Now, one thing to note, if it's a flat above a shop, realistically they don't attract the same level of value as a flat away from a commercial premises. So always be mindful that realistically you might have to drop the value of the flat by about 10% if you're only using comparables of flats in the area. Anyway, add together these and we will get a rough value. Now, one thing to note, the best way, the single-handed best way of knowing the value of your fish and chip shop is to call out a professional, a business transfer agent like ourselves, or there are others on the market. We will come out and we'll do an in-depth valuation of your accounts. We'll look through what add backs can be justified. We'll also look through each line item and see if things are being overstated or understated. Just as much as you can do an add back, you can do the opposite, which we do often have to do to get a realistic value of the business. Calling out an expert agent who sells lots of these is definitely your best way to do it. When we turn up to evaluation, we come prepared with comparables. So we sit there, we have a list of recent businesses that fish and chip shops in this case that have sold. So we'll sit there and we'll show you what values we have been getting for different fish and chip shops in the area. So always that is the best course of action. Now, normally speaking, agents don't charge anything to come out and see you and give you a rough idea of the marketing price. So please feel free to take us up on that offer. Okay. If you're just doing it just to get a steer in your own mind about the value of your business, this is definitely a really good way of doing that. So lastly, now this spreadsheet is what we use day to day in the operations of our business to give us an idea of the value of businesses that we go out to market. So what I'm happy to do is I'm happy to share this spreadsheet with you. And what I'll do is I'll put a link below in the comment section as to where you can get it from. Click on the link, put your details in, and I'll personally email you a copy of that. So I hope you found this business really interesting. Business, put my brains back in gear. Hope you found this video really interesting, and if you've got any questions, comments, or anything you'd like to add, or anything that you think I could add, provide you with that might help you in the valuation of your business, pop it below. And I hope you have a wonderful day. And if there's anything we can help you with, give us a shout. Thank you very much.